Hi there, Stan the Annuity Man, America's annuity agent, licensed in all 50 states, including that beautiful one you're sitting in. Today's topic is about you, about the questions that people put down below me. Look down below, scroll, right? Okay. If you put questions down there, guess what? I answer them. Yes, I actually read them. I have no life. I've been married for 33 years. I have 2 grown daughters. I have no life. This is what I do. I'm Stan the Annuity Man. And yes, I do love all annuity haters because all annuity haters already own an annuity. It's called Social Security, but I digress. We're going to start talking about these questions. And I have this, look at this clipboard. Isn't that cool? The Will Do Not Might Do studio has its own clipboard. How about that? We're not messing around. This isn't a hobby. This is what I do. I'm America's annuity agent. We're going to get to the questions after this. All right, I'm back. We're going to read from the clipboard, and I was told by my producers and the masters of the universe behind the camera that makes Stan the Annuity Man look so good. You're saying, how do they do that? I mean, they're professionals. I mean, come on, I'm hiring the best. But I'm clicking this. It's like click, click, click. Like, stop clicking it. I'm trying, okay? Here we go. First question. I'm going to try to read it. I'm going to hold it up so I can brand it. Will Do Not Might Do Studio. And the question is from E=MC. Love that. That guy's probably, or lady, smart. How can an annuity company give a better rate than a CD? And his comment was kind of funny. He's like, you kind of covered it in a video and you brought it up and then you didn't answer the question. That happens occasionally because I'm rolling, I'm riffing, I'm bringing it. I'm excited, I'm passionate about the annuity space. But there are times, like my CEO will say, that was a really good video, and you asked the question to yourself and then you didn't answer it. So I'm going to answer it now. So how, CD rates right now at the time of this taping, check the date, they're a little low compared to, say, Jimmy Carter rates. And Jimmy Carter, bless his heart, is building homes in Georgia somewhere. He's like 93, okay? But MYGAs, multi-year guarantee annuities, are the fixed rate annuity, is what you want to call it. It's the annuity industry version of a CD. It has a specific guaranteed interest rate for a specific period of time that you choose. No moving parts, no annual fees. You don't have to annuitize it. You're buying an interest rate. But at the current time of this taping, multi-year guarantee annuities destroy, beat, pound. They're just so much better from a yield standpoint than CDs. Will that change in the future? Maybe. But here's the reason why that multi-year guarantee annuities, which are issued by life insurance companies, can offer a better yield than a CD. Because I get the call from Chester all the time, like, let me tell you something, I don't understand this, because, I buy these CDs. Me and Martha love CDs. Going to the bank, they give us, their toaster and stuff, and buy the CDs, and now they're not yielding crap. And I'm like, I understand that. And he's like, Chester's like, why are these MYGAs so much higher? It's like you're forcing me to buy MYGAs. Not forcing you to do anything, Chester, but MYGAs issued by life insurance companies. Life insurance companies have what I call a dynamic pricing model, which means that life insurance companies sell life insurance. They sell lifetime income products. They have bonds in their portfolio from Jimmy Carter, Barack Obama, Bill Clinton, and Bush, and Trump, and all these people that are yielding pretty good amounts. And then they look at current interest rates. So there's 4 or 5 legs to that pricing stool. And from that, they can offer a higher rate because they're not trying to make a home run on the money. They're trying to make, say, 50 basis points, half of 1%. So if they're offering 3%, or they're trying to make 3.5% to give you and guarantee the 3%, and they're making that extra. It's really that simple. Now you say, well, wait a minute. Life insurance companies are doing life insurance and lifetime income. How does that play into the pricing? Well, as I always say, annuity companies have the big buildings for a reason because they know when you're going to die. Life insurance companies, right? Nod your head. They know when you're going to die. So those pricing mechanisms with life insurance and lifetime income, those are profitable. They know when we're going to die. They really do. It's a transfer of risk. And so the MYGAs are beating the CDs right now because CDs are primarily pricing that yield on the current 10-year Treasury note. There's some other factors, but that's the driving factor. So you're saying, wait a minute. At the current time of this taping, a 5-year MYGA is 2 percentage points higher than a 5-year CD. How's that possible, Stan the Annuity Man, America's annuity agent? How? I just explained it. All right, next question from a valued viewer of the Stan the Annuity Man YouTube channel. Once again, put in your questions. You could be a superstar. You could be on the Stan the Annuity Man YouTube channel. I could be reading your question. Next question, holding up the will do, not might do clipboard. A little branding, how about that? Over my shoulder as well. And this is from a person named Flawless Victory, which I really like. That's actually a really good name of a band if you're doing band names like, ladies and gentlemen, I'd like to introduce Flawless Victory. It's like, never mind. So Flawless Victory's question is, what do you do if CPI, inflation, consumer price index, isn't accurate and inflation is 15% for the next 4 years? Ask Flawless Victory. Inflation is that gorilla in the room. It's what at the time of this taping, the politicians like, do we really have inflation? I don't know if we have inflation. Is it really inflation? Yes, it's inflation. Go to the grocery store, go to the gas station. It's inflation. But Flawless Victory here is asking, he or she, what do we do? How do annuities address inflation? Well, you're going to hear a lot of really good sales pitches out there that, I got the annuity that can solve for inflation, Mr. Jones. They don't, okay? Annuity companies have the big buildings for a reason. They don't give anything away, nod your head. They don't. If you want to attach a COLA, cost of living adjustment increase, to an income stream, a lifetime income stream, the annuity company just lowers the initial payment when compared to the exact same annuity without that increase. Now, in the past, back in the day, when I was a little bit skinnier and I had less gray up top on the roof here, annuities did offer what's called CPIU, Consumer Price Index for urban consumers. They offered that as an increase to an income stream. At the time of this taping, that no longer exists, but it really doesn't matter anyway. What you have to put in the back of your head, put it back there and lock the door. Annuities of any type, regardless of the sales pitch, nonsense, do not solve for inflation. Yes, they can increase the payments, but typically if you run the number as compared to an annuity that does not have that increase, it could be a 6 to 9 year break-even point, from the time to make up for that increase. Now, so the question is then, and this is the question in your head and you're yelling at the screen, great, Stan, what's the solution to inflation? You're talking all this stuff. What? Okay, stop yelling. I'm going to tell you to stop. With annuities and the ones for lifetime income, if there is inflation, let's just say you have an income floor. You have Social Security. Yes, you have an annuity. Social Security pension, if you're so fortunate, dividend stocks, whatever. That money that's coming in every single month, that's hitting your bank account, and you're saying, wait a minute, we need like $500 additional dollars. It was fine 3 years ago, but now we need $500 additional dollars. Stan the Annuity Man, what do we do? Here's what you do. We do a reverse engineered quote. On our site, you can do that. You can go to our site, theannuityman.com, run quotes, and reverse engineer. What does that mean, Stan? Were you an engineering major? No. I played basketball in college. I was not an engineering major. I engineered in free throw shooting, okay? Could shoot free throws. Reverse engineering means that you need $500 to start now. Then you can run the quote to find out how much money is needed to solve for that $500. I always tell people, use as little money as humanly possible to solve for the solution contractually that you need with annuities. I know the annuity guys are like, shut up, Stan! Stan, you are once again undermining the annuity industry from getting all the money. No, I'm telling the truth, okay? Use as little money as humanly possible. So if you're saying, how do we address inflation? That's how to address it. At the time you need more money added to that income floor, we do a reverse engineered quote to use as little amount of money as humanly possible to solve for that contractual guarantee. Next question you're asking. Okay, that's great, Stan the Annuity Man. What happens when inflation increases again? Spoiler alert, we do a reverse engineer quote again. That's the best way to address inflation. Okay, here's the last question for this video. Man, this is fun, right? These people are superstars. The next superstar to enter the Stan the Annuity Man studio is a person named K. McNitt. Not sure what, like the letter K. And the question is, how does the state backing work for MYGAs, multi-year guarantee annuities, and why do you not consider that? Good question, Kay McKnight. I really appreciate McKnight. It's not McKnight, it's McKnight. Stan, come on, read it. It's a good question. And the reason, I've covered this in my other videos, as you know, for all you people that watch Stan the Annuity Man all the time. State guarantee funds, each state has a state guarantee fund that backs annuity purchases up to a specific amount. In my opinion, Stan the Annuity Man, America's Annuity Agent, I think your sole decision-making on the purchase of the MYGA should be on the claims paying ability of the carrier. Now, that state guarantee fund could serve as a nice little warm safety blanket for you, and you can go to that site at www.nolhga.com and check out your state guarantee fund. But I had a call recently from a gentleman, and he was so concerned about the state guarantee fund. I kept telling him, it's not FDIC, it's not FDIC, it's not FDIC, it's not FDIC. FDIC covers CDs, right? That's the coverage for CDs. It's not that. I mean, that's the best coverage. I really believe, regardless of the annuity type, and MYGAs fall into that, you're looking at the claims paying ability of the carrier. Now, if you go to my site at theannuityman.com, we have a live feed of the best fixed rates, the MYGA rates, for your specific state. You go there, you punch in your state, it's a drop-down, pick your state, then there's a drop-down, pick the duration that you want to see, 5-year, 3-year, 7-year, 2-year, whatever. If that company has made my list, then I've looked at it. If that company's showing up on my list, on my MYGA feed at The Annuity Man, then I have looked at them. I have looked at their claims paying ability. And remember, with multi-year guarantee annuities, we're not marrying the company for life. We're marrying the company for that specific duration. So my analysis is, can they back up those claims? Can they guarantee that percentage for that specific period of time? And if it's made my list, okay, then I have approved it. Now, you can ask me a question, do you really like XYZ company? I'll tell you, I've looked at it, blah, blah, blah. And I have the responsibility to tell you if you shouldn't put your money there. My rear end, yes, my big rear end is on the line with that. And I take that seriously. I'm Stan the Annuity Man. I mean, I'm not going to sell you something with a crap carrier. I'm just not going to do it. That's not what I do. I mean, I take this serious. And I put myself in your situation. You're putting money into an annuity company. You're sending them money on my recommendation. I take that seriously. So that's kind of the reason that I don't really go into the state guarantee fund. If that's where you want to go and you say, Stan, I want to split it up underneath the state guarantee fund, I respect that. I respect your decision. It's your money, and you're going to make your decision on your terms and on your time frame. But my opinion, claims paying ability of the carrier. Hey, I encourage you to put some comments down there. Type them in. Be as long as you want. I don't care. I'm going to read them because remember, I have no life. And I'm going to answer them, and maybe you'll be on the next Stan the Annuity Man video. Hey, do me a favor. Hit subscribe, share, tell your friends, you're not friends, everybody you know, and I'll see you on the next Stan the Annuity Man video.